Hello and welcome to Raise Your Average. My guests today are our co-hosts on this show, Mike Philbrick and Rodrigo Gordillo. They are principals at Resolve Asset Management Global. They're also sub-advisors to the Horizons Resolve Adaptive Asset Allocation ETF, ticker HRAA. At the heart of our conversation, we're going to be talking about a chronic problem almost all of us investors are afflicted by. It's the fact that the overwhelming majority of us are under-diversified. Profoundly under-diversified. And the worst part of this is that by the time we discover this truth, it's often too late, and there we are, caught with our pants down. This time is no exception. This past year and a half's conversations here on this show with some of the industry's most interesting and successful thought leaders has been so highly instructive on this topic. What's also come out of all these conversations is that our fellow hosts, Mike, Adam, and Rodrigo, not only love to talk about what they do a lot, and what they're cooking, they also, more importantly, eat their own cooking. So it's fitting that today we're going to be talking thoughtfully about how Resolve eats the free lunch of global diversification. So stay tuned, hit that subscribe button, let us know what you think.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Mike, Rodrigo, what's up, guys? What's going on?
All kinds of fun stuff's going on. The world is right again. Diversification matters. Risk management matters. It's dispersion is amazing. It's awesome. Yeah, no, I mean, it's probably not awesome for most. And as you said in your introduction, Pierre, folks who have sort of fallen a little bit prey to some overconfidence bias, driven by recency bias of certain assets performing and whatnot, have now kind of gotten a bias in their portfolio which favors traditional stocks and bonds only. It's been a decade of a proverbial wasteland in diversifying assets such as precious metals or commodities, or hedge funds, or funds that short things. And so now we find many investors being caught flat-footed. They don't quite have the exposure to those inflationary assets that will drive some returns during inflationary impulses. And how could they really? I mean, it's been a decade where those assets could be largely ignored, but now a bit flat-footed. What should I do? Who should I allocate to? How should I work that in? When should I pull it back? When do I make a change? Will it come back? All of this sort of iterative thinking that sort of undermines good, thoughtful decision-making and portfolio construction. So those things are a bit of our specialty. So at Resolve, we design and deploy systematic strategies. So systematic means, rules-based strategy grounded in some well-established investment principles. We do our own proprietary quantitative research, and there's, a little bit of machine learning techniques deployed in there. And we offer those strategies on behalf of, ETFs, mutual funds, some separately managed accounts, and hedge funds. And so, business has been pretty good over the last 6 months. I can tell you, it was a tough sled to push for the last decade. Pushing risk management and diversity has not been the most popular thing. But here we are. The sun is shining, and the wheat is ready to be harvested. I guess.
That's good.
A commodities play, I guess.
So I think you already sort of preambled a little bit, but people know you guys as our co-hosts on Raise Your Average. But I think it's time for us to get a real intro to Resolve, to you guys, to what you actually do for a living and what you focus on. And then we'll get to how investors have largely ignored some important line items in their portfolios.
Yeah, I agree. I mean, I think as I mentioned, we are all about diversity, global strategies, risk balance strategies, and doing that through the eye of a mathematician, if you will, and taking the calculus to a level where it's kind of impossible for the human mind to contemplate the different types of asset classes, the balance, and whatnot. So we basically boil that down. At the end of every day, a whole bunch of assets in the world trade. Markets close. We run our models. We understand the relationships between those assets, the correlations, the volatility of those assets. and the differentiated nature of those assets and what their expected returns are. And we rebalance those portfolios on a regular basis, anywhere from looking at shorter term, 1 to 5 days, to some longer term items in different implementations of the various strategies across the different structures we might be offering these strategies through. So that's sort of the basics.
Yeah.
Rod, what would you add?
I just think from a very high level, what's important to help advisors and investors differentiate us from other asset management firms is that we've not ever picked a stock in Resolve's existence. We don't do any stock picking, right? This is where 99% of computational brain power seems to go into, Microsoft versus Apple, investing in smart beta ETFs that are long only in the equity space and happen to be domestic. Our focus is exclusively being on the asset allocation decision, which we've all been taught to emphasize and understand that 90% of the directionality of your portfolio is in asset allocation rather than security selection. And yet we don't apply that knowledge. So what we do is we pick asset classes globally: domestic equities, international equities, U.S. equities, sovereign bonds across the German Bunds, the UK gilts, Canadian treasuries, Canadian bonds, government bonds, U.S. treasuries, and so on. We span the whole spectrum of commodities, the energies, the grains, the softs, the metals, as well as currencies, right? Because this is where the action is. If you want to maximally diversify a portfolio and have the opportunity to not just survive a bad recession or an inflationary regime, but actually thrive in it, you need to contemplate that universe. And therefore, that's the lens by which Resolve Asset Management.
Why do you guys think it is that, going back 20, 30 years, those statistics have always been true. They've always been out there, and we've all been aware of it for this entire duration of the last 2-3 decades, that diversification, asset allocation, is responsible for 90% of the outcomes that we get in our portfolios. Why do you think it is that even though we know and this stuff gets pounded into us, why do we ignore it?
I think it's human behavior. You get what's happened most recently. That recency bias tends to drive you to certain asset classes. In 2008, after that major correction, not a lot of people were, running out to buy the US 60/40 portfolio. And, if you look at that run from 2000 to 2007 and 8, when, Canadian stocks, emerging market stocks did particularly well, portfolios had a lot of commodities, and they had a lot of commodity related products in them, just as we were about to enter into a decade-long bear market in commodities. And flip the script a little bit, right? NASDAQ peaks in 2000 and does nothing for 14 years. It has the correction in 08 along with everybody else. So it's got negative, 60% total return for an 8-year time frame. Nobody wants to own that at that moment in time. And so we find ourselves to some degree in that maybe peak balanced 60/40 US exposure. If we go back through time, that portfolio has a Sharpe ratio. So the risk adjusted returns for the 60/40 portfolio are about 50 to 60 basis points. Well, the Sharpe ratio has been 2 over the last 10 years. That is almost a Six Sigma event away from the mean.
Yeah.
And so when you spend time above average, in order to get back to average, there will need to be some time spent below average. And so, when does that time come? Is today the moment? Well, if we think about the inputs, the inflation and growth dynamics that drive asset prices, they have been very conducive for a portfolio made of stocks and bonds, especially in the domestic area in the US. You have growth, low inflation, and you have abundant liquidity. That's what's happened in the last 10 years. We now are going to have a 10% CPI print. So inflation is not low. It's not benign anymore. Growth is stuttering, if not slowing outright. Yeah. And further, we get the last thing is we have this contraction or movement away from abundant liquidity. We were quantitative easing, which is ending. which when something that's easing ends, it is tightening, along with interest rates that are rising. So those three legs of the stool that have been such great supporters of the 60-40 portfolio, global growth, benign inflation, abundant liquidity, have now reversed. We now have contracting liquidity. We have inflationary impulses, and we have slowing growth. Asset classes that perform in that regime are very, very, very different than the ones that have enjoyed the sunshine for the last 10 years.
Yeah. I think you want to look at this chart to understand why 60-40 has dominated our psyche for so long, right? This is a chart that goes from 1900 to today, identifying, so the equity line here is a 60-40 US equity portfolio in real dollar terms, which is important here, right? It's what matters is your actual real growth. And the beige areas are periods where you have that benign inflation, persistent growth, and abundant liquidity. And the last time, with the exception of the mid-noughts, right, 2000 to 2010, which we have forgotten about, we forgot that was a rough period for 60-40. If you think about when finance really started dominating and being from a small portion of GDP to being one of the largest portions of GDP, and many people getting into financial advice and financial portfolio management, having retirement accounts, the RRSPs, RESPs, and 401ks and Roth IRAs in the US, that period started in the 80s and has grown in its importance. So from 1981, when Volcker broke the back of inflation, to today, we have been dominated by a secular regime of disinflationary growth. And so when you're in that period, there's very little that can beat a developed equity and bond portfolio, which is what a 60-40 is, with the exception of that small period of 10 years. And as Mike alluded to, the last 10 years have been outstanding, possibly the 99th percentile best Sharpe ratio in its history. But note that in any other economic regime, whether it's inflationary growth, deflationary bust, deflationary bust, or stagflation, like in the 70s, your 60-40 portfolio is going to underperform. By underperform, I mean no performance, right? Zero is what we see in history. So it's tough to get this point across in the middle of a disinflationary growth regime. I think we're finally getting there.
Well, yeah,
I'm often reminded of the Nassim Taleb story of the turkey, right? I mean, a turkey doesn't know Thanksgiving Day is coming. Right. And, as the turkey gets closer to Thanksgiving Day, the farmer feeds him more and treats him even better and keeps the foxes away. How's the turkey to know that Thanksgiving is upon us?
I think it's ironic that, it takes us so long to let go of our emotionality. It takes us, you have the .com crash, and then, it took literally 12 years for us to resume interest in technology stocks. And now we've had a decade of this disinflationary boom that we're talking about. And how long is it going to take for us to let go or unwind the emotionality of how well the last 10 years went before we actually start to make meaningful or thoughtful decisions for the portfolio that put us in a good position for the next 10 or 12 years?
Nothing motivates like a crisis, right? I mean, it's always going to be crisis, necessity, change. And you'd be surprised, Pierre, how much change is happening that we see. We are definitely seeing a strong adoption of what we're going to discuss today, of protecting against bond bear markets, protecting against equity bear markets. It's happening, and it's happening quickly. Of course, the best time to plant a tree is 50 years ago. The next best time is today, right? So better something than nothing. At least people are acting.
I mean, I think, how we met and how we came to know you was through the amount of education that you guys have been producing over the last decade through this period that was really, as you said, Mike, a tough sled to push. And let's get into your research. What motivated you guys to, what made you realize that you have to, you put all the cards on the table and show everything you know and say, and make this effort, this gargantuan effort that you guys have been making for a decade to get advisors on board?
It's a good question. I think it starts with our personalities. I think Mike, myself, and Adam we love to seek truth in uncomfortable discussions. And we've always had that with each other. People love to be fly on the walls when we're going at it. And while it may seem uncomfortable, it often leads us all to move to a place of commonality. It's an ongoing process, but those discussions lead to insights that it would be folly not to go out and tell the world what we're thinking and what we're discovering as we have these discussions. And our personalities are ones of liking to coach, to educate. It's always been part of our DNA at Resolve. And we're lucky that we have enough people on the team that can clearly articulate that in writing. Adam's a fantastic writer. We all help in the narrative, but he can distill it very clearly. And then, from being able to put on a podcast and be able to articulate things well, Mike and Adam and ourselves are pretty willing to do that and then take the backlash on social media when we get it.
Yeah, and you guys and
so that's part of it. It's our personality.
And a big part of that is that the three of you plus the whole Resolve team, you don't agree with each other on everything. Or
no, we certainly don't.
Rarely agree with each other.
And we certainly do that.
It's an honest
in public.
Yeah. So that's one aspect. The other aspect is where we went into is so esoteric for the average investor and advisor that there was no way that we were going to find success if we didn't do our part in breaking it down piece by piece, time and time again, telling the same story in different ways until we got to enough people that were getting, they're taking the red pill and not coming back, right? Once you go down the rabbit hole, it's not the Resolve rabbit hole. It is the truth rabbit hole. It is the understanding and recognition of the true dynamics of markets and what you can do. There's no turning back. So what's been beneficial about the content that we put out is that once we get people to go down that rabbit hole, we seem to keep them for a long time as dedicated and loyal, followers and investors. Unlike, just trying to say, dividend stocks, we run a dividend company. You understand that fully, right? We're slightly better than the competition. And then you get a bunch of assets, and when you underperform, you get redeemed, right? We have a following that has led to people adding to our products when we have
I think a big
that's
the
key
part of that, Rodrigo, is that what's really refreshing about the way that you guys have gone about it is that you're honest about the fact that you don't know. You just simply don't know what's going to happen. And I think what you've taught, what you've done, what you've gone to great lengths to teach, and sort of what I've sort of gleaned from it, from all of our conversations, is that is to let go of those directional biases, to let go of what what we all think at any given moment is a high conviction bet that we're willing to vote with our money. I love that Voltaire quote, about uncertainty. It's one of my favorites, and you guys happen to use it, but there's nothing worse than, nothing more risky than having this high conviction that your bet is the right one at any given time. And that's why diversification is so important, the kind of diversification that you're talking about, that we're going to talk about. And you got what's really cool is that you guys have distilled it into your strategy.
Yeah, and I think my favorite quote is from Mark Twain, just to throw it in there, and then I'll pass it on to Mike. It's the idea, his quote is, it ain't what you don't know that gets you into trouble. It's what you know for sure.
And is that your favorite?
So
is that your favorite?
That's the world we live in.
Or is that Mike's?
It's my favorite. That is my favorite.
It's one of mine too, for sure.
Yeah,
for sure. But I think the idea of sharing too is something that I'm very comfortable with, and I think I've had to some degree, help our team understand that, it's Docaine from the turtle traders. And he said, it doesn't matter. And I don't know if you remember Docaine, turtle traders. And then you had, sort of the great movie with Eddie Murphy trading places with Mortimer and Randolph Duke. And they were emulating, William Eckhart and Richard Dennis back in the day. But, the trading greats said, you can publish your rules, your winning rules, just put them on the front page of the paper. No one will be able to follow them because they haven't internalized what it means to follow them. They've seen some sort of profit outline or some sort of percentage thing that they suspect to get, but they haven't traveled the path. And we have encountered this many, many, many times where institutions or other investors or have tried to emulate what we do in adaptive asset allocation. There's been whole parts of certain pension funds we've heard of where they've said, oh, we're going to take this concept and run it. And it always seems to go awry. They want to put their own twist on it. They want to throw a bias on it. They don't quite fully understand the philosophical journey that they're on. And so sharing very openly about that journey and how hard that path is to walk and then staying true to that path is a big part of getting people to adopt this. And it's very much in my mind still a blue ocean strategy. It's still a strategy where we're doing something different. The reason the Porsche is still an amazing sports car is because the engine's over the back wheels. And that is what makes it, you can doll it up, you can paint it, the stereo in it sucks. And you can try and line it up against a Maserati or an Aston Martin or whatever other supercar that you would like this little VW Bug with the engine over the back wheels to eat its lunch. So the engine over the back wheels from a Porsche's perspective is very much, hey, asset allocation matters more than security selection. Yeah. That's a concept that still has not been sort of well adopted. And so you have to share, you have to, sort of take it to the highest mountaintop and yell. And then people will, in the short run, say, see, you're wrong. Look what happened over the last 3 months or 1 month ago since you said that. And, what's misunderstood is that these things happen over time frames of 3, 5, and 10 years. Look at the cycles we've talked about in the past, whether it was the tech cycle, the resource boom, the second resource boom, the oil embargo of the 70s. Again, these things are longer moving cycles, which does give time for people to prepare. We're seeing early adopters now start to say, wait a second, there has been a regime shift. How do I deal with this? Hey, let's call the guys at Resolve, because they've actually thought this through. And because we've been talking about this for 10 years, at least they know who to call.
Yeah.
It's kind of like Ghostbusters. We got a ghost. You call Resolve. If you want more 80s movies references, I'm here all day.
You know what? I remember from our conversation with Hugh Hendry not too long ago. He talked about, one of the things he talked about that was really an interesting point was that, when he thought a decade ago or 12 years ago that China was going to bust, he honestly just comes out and says, he was way too premature. What he realized was that, he sort of put this idea together that the Chinese zodiac is based on 12 years. And, and what he misunderstood was that, what he thought was imminently going to happen would actually take a 12-year cycle to unfold because of the,
And what I loved about Hugh's thought process was, if we're going to get to some deflationary, Dave Rosenberg type of scenario, well, it's a sine wave. You got to snap the rubber band way over here, and then some stuff has to happen to cause governments to rip it back down here. It's not something that can just manifest on its own. You've actually got to bend, or you got to stretch that band in one way in order to get it ripped back the other way. So as he's gone through hey, here's how we get back to zero rate. So let me roll that out for you. it's pretty epic because you've got to do what we're doing, get this really massive inflationary impulse, have central banks of the world have to orchestrate a slowdown in growth to allow supply chains to heal and allow the resource components to catch up to the potential growth, which then means you have this growth cavern, which means, economy collapses again, and then you have to go back to zero rates again in order to restart the whole system. And so he's got this very interesting way of thinking about how things proceed to an eventuality and what's required in one direction in order to make the thing that you think is going to happen in the other direction.
Yeah.
What's amazing about that, and what's unfortunate about the way we see portfolios today, which tends to be dominated by 60-40, or maybe it used to be. Now it's more like 80-20, and the 20% is more like private equity and private credit, which is just more equity, but without market to market the volatility. Is that what you just described, Mike, is a period of like back and forth between inflation and recession. What are the two blind spots for the 60-40 portfolio? What are the two things that they're most susceptible to? Right? Like, I mean, you got your bonds, we're seeing it. You got bonds getting crushed at the same time as equities. Why? Because we're seeing a dual inflation and recession, i.e. stagflation. But this is going to go back and forth. There's going to be a period of, there's going to get to a point where it's going to be a pain point. They're going to, the Fed and the governments are going to do fiscal and monetary spends. That's going to lead to a reflation. It's going to lead to growth, but bonds are going to continue to suffer because inflation is going to happen. So this yo-yo, this period of inflation volatility, we have not seen since 1981, since prior to 1981. And AHL, was it AHL, Mike? I think AHL put a report up that showed that. Like, what were the differences in
inflation volatility from 1925 to 1990 was about 4.8%. Since 1990, it's been 1.3%. So like a 65%.
And what people don't understand is that recession and inflation come hand in hand. This is just, it has to, right? Because remember what the dual mandate is of the Fed governor. It's to balance inflation versus growth. And what Volcker had to do in 1981, he had to break the back of inflation. And the consequence of that was a massive recession, right? But it's what is the medicine that it requires. So what does 60-40 need? We need to fill in those blind spots, right? This has been the major focus of our research for more than 10 years. And how we've structured our products.
But see, isn't it funny how, like, I just think it's reminiscent with your journey, like the length of time that you guys have actually been on this journey to talk about all these different components, sort of parallels what we're talking about as well. I mean, even on a very, on a simple point, it's like for the last decade, fundamentals have fallen on deaf ears. For the last decade, diversification has fallen on deaf ears, has led to these unbelievable biases that culminated in the end of 2021, and then the turn at the beginning of this year. I mean, this year so far has been just a rout, and so it's amazing to see just the way things unfold, how that's unfolded into so much exactly what you've been talking about for so long.
Yeah. And it's gratifying to see the portfolios respond in the way we have suggested they would. And many of the investors and clients along the way have been very heartened by that. And even the prospective clients have said, oh, actually, it worked like you said it was going to work. That never happens. I'm like, well, thanks for waiting and keeping us on the docket. But I think also just one more thing. The other thing is there's this inflation that's occurring, and I want to make sure we emphasize Rodrigo's point, because there's this mean rate of inflation, right? It is whatever the average rate's going to be. These dynamics of inflation and growth shocks create the volatility around inflation. That's what we saw pre-1990. It was volatile. The idea of inflation and growth, they were volatile. They have not been volatile since 1990. What happens? Well, you get assets priced for perfection. You get very high multiples because you've had benign inflation, because you've had consistent growth. because you had abundant liquidity, you get these very lovely valuations. Those have shifted. Even if inflation were to continue to moderate, run lower, there are going to be shocks that cause the volatility, the variance around the mean, to be higher, which means that asset prices have to have higher future expected returns, i.e. be lower than they are now, in order for an investor to justify investing. And this is happening across the board. So paying attention to how much risk you're taking, where's the balance of your risk in asset classes that respond to these various regimes is incredibly important and is at the core of what we do and have been doing for 10 years.
So those are the blind spots. Those are the blind spots, right?
Yeah,
I mean,
correct.
So how can investors, how can we think about filling in those blind spots?
Yeah, I mean, that's a good question. And a lot of advisors we're talking to, both in Europe, US, and Canada, immediately go to what's easy for them, right? So what's been comfortable and what do they know? They know stocks, right? And so immediately what they try to do is within that stock realm, they try to pivot towards inflation sensitive stocks. And that is a good, by the way, it's a good first step in rotating to the energy sector maybe, right? But the reality is that stocks on their own are half what the underlying product is. In this case, would be energies or commodities of some sort, but half is their cash flows, right? And so in a bear market, in a period where all of the economy is going down, there's less demand for everything, you're not going to have that diversification that you need on the inflation side by tilting towards the commodity-based energies, and you're going to get hurt on the bear side. So it's not a perfect product. So what's the next best thing? Canada especially seems to be gold. Okay, so gold as an inflation hedge, and sometimes as a disaster hedge, right? The problem with gold, of course, is that inflation isn't just monetary inflation, right? It's supply shock inflation. It is demand pull inflation. It is a wide variety of things. And people have gotten very disappointed with gold's performance in 2021 because the monetary inflation happened in 2020, right? That's when we went from positive rates to negative rates, where the gold is highly correlated to that monetary impact. And then flatlined when all the energy markets, the grain markets, all the traditional supply chain disrupted elements were making a killing. So you can't just do it with gold. So then you get into the passive commodity sleeve. You can buy the Deutsche Bank Commodity Index as an ETF, for example, right? And absolutely, that has been tremendous as a way to hedge inflation. But again, inflation and recession go hand in hand. So what has happened to a passive commodity index as a hedge during periods of recession, when the Fed finally starts fighting that inflation? You have massive, it drops higher, lower and more aggressively than your 60-40. It drops lower and more aggressively than your equity. So you've managed to momentarily fill the inflation gap of your 60-40, but you've supersized your bear market risk, right? And so again, we have an imperfect hedge for the two blind spots that the 60-40 have, right? A good hedge would be an outsized allocation to sovereign bonds when that recession happens, assuming there's no inflation. But of course, we have gone down to nearly zero allocation to sovereign bonds.
Not we, general investors, not we. We haven't. We in the sense of other people and investors.
Yeah, at large.
So that's kind of the paradigm. That's what I'm seeing, and that's what I'm seeing everybody stop at, right? They're thinking those are the things that we can do, and then it becomes their job to become traders as advisors. Now you have to trade when the inflation trade is over to get out of your commodities, and you have to trade when it's appropriate to go long sovereign bonds again.
Equally dangerous.
It's a tough gig. Advisors are focused on building their business. You want to create a strategic asset allocation that has those three engines: your equities for growth, your sovereign bonds for bear markets, and something that can fill in that commodity inflation and maybe help out the bonds when the recession comes. And to us, the natural next step, and AHL Diversified also wrote a fantastic report on this that kind of goes through what works, in long, short, multi-asset, the managed futures of the world, the trends, the carries, the value investing, this picking stock asset classes long and short across commodities, equities, bonds, and currencies have been always, from the beginning of our research, the ones that make the most sense. to fill in
Yeah.
both the recession.
But I seriously
inflation
doubt
gaps at the
that
same
advisors want to actually become Randolph and Mortimer. It's it's such a reach, and it's so outside of what the requirements of the profession are in terms of managing, your book and managing your clients, that why wouldn't you hand that off or delegate that responsibility to people who do it all day long, and that's all they do. They're not having to manage one-on-one their clients' expectations. Their bread and butter is literally just doing what you're talking about all day long, and without having to have the client management interaction, interrupting that.
I think one of the challenges there is that the advisor or allocator often will assume that role of asset allocation is theirs, and then they're going to delegate the security selection. The challenge then becomes, of course, what we see happen in portfolios is the line item risk, which is, why do I have this line item of commodities that went down 55%, then rallied a bit, then went down 15, back down to 55? Why do we have that over the last 10 years? And this is why many of those asset classes have been punted out of portfolios, both on retail and in institutional portfolios over the last decade and a half, because they've been a drag. And diversification, by definition, is a drag. You'll have something in your portfolio that's killing it and something that's killing you. And we perceive, our sort of no harm place to start is the all weather or risk parity portfolio, where you're balanced across the different regimes and you are including all of these asset classes. And you're saying, hey, I'm prepared, and I'm just going to de-emphasize prediction. We obviously, that to us is beta. That's the do no harm base of the market portfolio. Then, as Rodrigo alluded to, there's long, short, multi-asset strategies that are very accretive to that portfolio. But let's start with the no harm portfolio. Let's measure whether we actually add value with active bets in the portfolio or active allocations in the portfolio, which we do from our perspective. And then let's add those tilts to the portfolio. But first, be diversified, and be diversified. So people think a 60-40 is diversified. It's neither diversified nor is it balanced. The balanced portfolio is silly. It's 90% stock exposure from a risk perspective, right? So that's imbalanced. And, that's not diversity. You've got one basic bet, and it's overbalanced to that thing, and that regime has happened to work. So now, if you're in a risk parity portfolio, you've basically sailed through the last year quite nicely. Even the year to date, I think most sort of well-conceived risk parity portfolios are down 2 to 3%. Some are down a little bit more, some are up a little bit more, construction, but sort of average, maybe down 2 or 3%. Kind of a yawn. Not down 20%, not down 15%. It's kind of a, oh my God, it's happening in my portfolio. Oh, nothing. I'll go back to work. I'll go back to do the stuff. Because you were prepared, because you know the steps you're going to take, you know how you're going to rebalance, and those things are being done daily. And so that's where we would start. And in the Horizons Resolve Adaptive Asset Allocation ETF, in that particular product, the base is that risk parity base that we're talking about. First start there.
Funny how 10 years of S&P returns, S&P 500 returns at 16%, twice the historical average, is the reason why nobody's diversified up till the end of 2021. And though, what you just said, which was that the, if you look at the risk parity, average being, minus a few percent, a yawn, but, who wants the excitement of negative 20, minus 20%, right? Which then forces you to rush for the exit, like a crazy, I need diversification.
Well, as long as my friends are down 20%, I feel a little bit better about that.
Yeah, absolutely.
That's a problem with investing,
Yeah.
right? That's tracking error. And so that's definitely something that needs to be attenuated. And we've written on attenuating tracking error through return stacking, which is, okay, you've got the 60/40 as your tracking error sensitivity. So we need to make sure you get that. And now let's stack on all of these alternative sources of return to make sure that you can stay the course. You've got your 60/40, so you're suffering or celebrating with your friends. But hey, look at how we can enhance that even and give you all of that plus this diversifier. On our products, what we've sought to do is say, okay, well, we're not, I don't want to sign up for the 60/40 right now because I don't, it's not my tracking error and I don't think it's going to be a good thing to track for the next 10 years. So in our products, it's the risk parity, the most balanced, the highest Sharpe ratio portfolio of multi-asset, generally speaking, and then add the alpha on top.
Can you imagine? Can you imagine what happens if you're, if a bunch of people are at a party and everybody's down 20%, and then the one person who's at the party who's only down 2 or 3% speaks up. What would happen there? Like the immediate.
There's two sets of people.
So
go ahead, Rod.
Well, in a way, for my book, in my allocation decision that included this type of multi-asset long short, we're up 20% in that section of the portfolio. And overall, we're looking at 7% positive returns in 2008, right? And so I'll tell you what I felt when it first started happening, when that September, October came. I felt vindicated. I felt like high-fiving somebody. And when I put my hand up there was nobody around. Advisors were literally not around, literally depressed, right? I think anybody who lived it, I'm not even saying this as a joke. Like it was a tough go for any investor where associates were taking the calls for advisors, where friends of mine weren't getting callbacks from advisors because they didn't have anything positive to say. It was a really tough period. Obviously not all advisors, but a large proportion didn't show up. And I don't blame them. It is a depressing thing when you think your career, all the assets that you built were gone in a 3-month period, right? If you were a Canadian small cap manager focused advisor that killed it the previous 10 years and then got wiped out 70%, how would you feel? So for me, living through that was a moment of vindication and then actually wanting it to stop. I remember I kept, the portfolio kept growing, but I really wanted it to stop because it was hurting so many people around us, right? So it's not a point of pride that we're outperforming everybody. I don't want to be proud. I don't want to feel like I'm better. I just want everybody on board. And there's no reason not to diversify that risk away. I don't want advisors to be paid to hold people's hands when they're losing 50%. I want advisors to be paid to make positive returns when the equity markets specifically are down 50%. That's what I want. That's the dream. That's why we educate. And that's why we put HRAA, the Horizon Resolve Adaptive Asset Allocation Fund, provides that base balance of risk parities. And then on top of that, that pure alpha that's lowly correlated to risk parity, that's going long and short things, and has allowed us to be, for example, short bonds this year.
Yeah.
Right? The advisor needs to have a strategic allocation of bonds. We'll short for you, right? We can go long energies and grains. We can short the S&P and the NASDAQ while going long emerging markets. Like there's a wide variety of things that we can do that you can't to provide that protection. I think we're coming to a point where we can actually add that value, add that peace of mind. And so, what are people thinking in that party? They hate you. And then you hate, you for being that guy. To answer your question.
Some of them,
who the hell does that Rodrigo think he is?
Who's your advisor? I need to talk to him.
Exactly.
Don't invite those people back to the party ever again. You just never invited back. And the funny thing is, I don't think we're particularly smart guys. I don't think we're particularly dumb guys. We're sort of disciplined guys. And all of a sudden the last 8 months is, wow, geez, how did you know? We're doing the same stuff we were doing before. It's a bit of Groundhog Day. Here are the core tenets to successful investing. Here's how you do it. Here's how you layer them together. And here's how you attenuate some of the behavioral biases that you might have. That message for us has been pretty much the same for a decade. Now we're just popular at the party.
Because here's the thing, Pierre. We said a lot of things about we've disappointed people in the last 10 years, people that stuck with us. but we really didn't. Our longest running track record is 10 years. Has a Sharpe ratio of 0.85. Okay, that's twice that of the long-term Sharpe ratio of a 60/40. I mean, if you run that at 10% volatility, you'll get 8% rate of return. Isn't that what everybody wants? Right? Shouldn't everybody be happy
Apparently
about
not.
that? But of course, they're unhappy about that.
Yeah.
They're unhappy about that because you mentioned the 16% annualized return of the S&P. And so it's not that we failed. It's not that we disappointed. We put together exactly what we wanted, and the outcome was exactly what we expected. And year to date, as of April 29th of 2022, we're up around 10, 11%. No different than what we'd be up on average most years, right? There is no difference. This idea of all weather, this idea of being persistent and consistent, that's something achievable. And right now it seems crazy good because markets are down 15%, we're up 10 at 25% differential. By markets, I mean equity markets. But within that portfolio, we have things that are losing money as well. So that's the point. The point is not that we're doing something outrageously great right now, is that we've done something that is super accessible, middle of the line all years. And this is what happens when we can differentiate based on what people care about.
I think, and sorry, Mike, I just wanted to say that everything boils down to, like, it doesn't matter, good versus bad doesn't matter anymore. Everything is just better or worse. I'm doing better than, or I'm doing worse than, and everything is relative, right? I mean, a lot of the industry has shaped a lot of commentary around relative performance and what's doing better and what's not doing as well. But it's like when somebody, when you say to somebody, "Oh, how you doing?" and they say better, that doesn't mean good. It just means, it doesn't mean good, right? It just means better, and better could still be -10 versus -20. Yeah. And either way, that's not good. Mm-hmm. So like there's very little absolute talk in markets and investing.
Well, there will be once we get the bear market.
Yeah, but
you start to hear about absolute returns once we have 20%.
But as an advisor, do you really want to wait for that? Exactly.
No, I don't think so. And there's been the other thing that's occurred in Canada that has been quite advantageous for Canadian investors. Canada continues to be on the leading edge of a number of different product developments, and one of the things that allowed us to create HRAA, or Horizons Resolve Adaptive Asset Allocation portfolio, we were running a pure risk parity portfolio, but you couldn't get leverage into an ETF. That was prior to the liquid alt regulations changes. Now, once we had the liquid alternatives regulations update, and they allowed for some use of leverage across a diversified portfolio, all of a sudden, some real doors opened for providers and asset managers like us to partner with Horizons and really offer an absolutely kick-ass product to investors. And there's a couple of very unique features to this that are exceptional, that are literally not available anywhere else in the world that we should talk about. So not only is it a strategy opportunity, it's a structure opportunity. And structure often limits strategy. In the case in Canada with liquid alts, this is a medium risk product, and as a medium risk product has just tremendously attractive tax considerations and tremendously attractive sort of portfolio construction opportunities within it. I don't know if, Rod, you want to elaborate on a few of those?
Yeah. So let me parse that out. So what Mike means by moderate risk is that we run it at volatility target of 8%.
Right.
This is very similar to that of a blue chip bond portfolio, but without the tail risk. A blue chip bond portfolio, we've seen drawdowns of 35, 40% in 08. Because of the diversification benefits of what we just described, we shouldn't expect, we should probably expect half of that drawdown in the future history of the future of this product. So that's from a structural perspective, from a volatility perspective, and labeling within the vast majority of broker dealers. We run at medium risk, which means that advisors can allocate a significant amount to make an actual difference to their portfolio.
So that's key. Saying that you run at 8% volatility, that's basically a cap on the amount of volatility that the strategy.
Well, it's an average.
Yeah.
It's an
plus or minus 2%,
minus
depending on
on
market
average.
conditions. But yeah,
over
that's the average.
my market cycles, 8%.
But it sets a ceiling, like a put. Like it sets a ceiling on how much volatility can be expected or experienced. Yeah.
It's an important aspect of risk management
Yeah.
on drawdown, for sure.
For sure.
Right, drawdown meaning maximum peak to trough loss. And then the other structural advantage, I mean, one of the reasons why this all-weather concept and investing in futures in Canada has not been widely adopted or widely offered. We really are like one of a very small handful of public products available in this space, is that futures are taxed really inefficiently, right? And every year, regardless of whether you bought or sold, you are mark to market on what you made, and you pay a full income, whatever your income is, on that P&L, and you get a tax slip that you have to pay. So that tax inefficiency, there's no capital gains, there's just pure income. So why would that be attractive? Well, within the Horizons corporate class structure, we have an ability to redistribute that. So there's no expected distributions at the end of the year. And as far as I can tell, and this may have changed, we're the only ones in Canada that have this ability, right? So within this handful of structures that can do long, short, multi-asset across commodities, equities, bonds, rates, and currencies, we're the only ones that can keep that in people's pockets until they sell, and when they sell, it's
But that's seriously, yeah, I agree with you. That's seriously important. That's something that anyone who would try to do these things on their own would not have the tax efficiency that you've accomplished there.
And then the last thing I'll say, because we threw up the liquid alt label, I think it's kind of like saying equity manager, right? There's many styles within that space. And in Canada, the liquid alt space is dominated by traditional long short Canadian equity managers. It just more the same. It's just like, the S&P TSX 60 with a slightly lower volatility. That's not going to give you inflation protection, and it's not going to give you bear market protection, most likely. Okay. Within the many alternative sleeves that exist in the world, and if you go to the HRAA index categories, you can kind of look to see them. We have a chart that I can, link to that shows a correlation of all of these: stat arb, merger arb, long short equity, market neutral, and so on. Every single one of them has a positive correlation to the S&P and a positive correlation to bonds. The only category in the hedge fund space that has very close to zero in both equities and bonds is the SocGen CTA index, for example, or the Goldman Sachs Global Macro Systematic Index, which is kind of the two categories we would fall into, right? So this is a unique liquid alternative. Within the liquid alternative space, this category, in my opinion, is the most crucial to really focus your attention on and get educated on, because it's the most likely to fill in those key gaps, right? So that's another structural reason why we're so excited about this product. I can't wait to see what this looks like in 10, 12 years.
Yeah. What are the actual moving parts of HRAA?
So the moving parts are, we've addressed quite a few, right? And there's a ton of education on it if you guys want to go to our site, and we'll put some links to it. But really it's trying to, everybody's probably at this point heard of Ray Dalio, right? And heard of Bridgewater. I mean, a huge inspiration, right? You want to have a sense of humility, and you want to have the belief that you can do better by your profession. And our profession is one, of course, of trying to predict the future and trying to pick the right asset classes at the right time and the right weights. Let me talk about the humility part. That's risk parity. The idea of risk parity, it's an explicit recognition of our ignorance. It's the belief that it's okay to have things killing it and have things in your portfolio that are killing you in order to have that balance, right? So that is the first layer of HRAA. For every dollar that you give us, you're going to get a dollar risk exposure of risk parity. That is our attempt to be humble and to participate in global ingenuity and global growth. It is a long only strategy. And it's a long only strategy that's tactical because we're putting our risk parity goggles on. And instead of giving commodities, equities, and bonds in equal dollar weight, what we're doing is we want equal risk contribution. So that means that when I put my goggles on, I can see how risks are changing by how much they're correlating to each other and what their relative volatilities are. And so, for example, the last couple of months, equities and bonds have become highly correlated. And so a risk parity portfolio will de-emphasize both of those assets and emphasize commodities, not in an attempt to predict the future movement of them, but in an attempt to maintain that perfect balance. Right? So you have that key component of humility. And then we believe we have expertise in trying to predict the next 5 days movement of all these asset classes, right? So we're not trying to predict what's going to happen to commodities over the last 12 months. We're legitimately trying to just try to find on average what's going to happen in the next 5 days. And the second layer, so for the other dollar that you're going to get in risk exposure is going to be in this systematic global macro, which is just a fancy word for saying I can go long and short all these asset classes over 50 different futures contracts. And at any given day, I have an equal chance of going long and short each one of these. And so the correlation of this stacked asset class or strategy is zero to that risk parity. And so what you're stacking is whatever return you get from risk parity, you're going to get. And whatever return you're going to get from the systematic macro, you're going to get. You're stacking those returns, but because of the zero correlation, you're not necessarily stacking the risk. Right? It's zigging and zagging. It's buying a ski company that has cash flows in the winter, and then also buying a bike company that has cash flows in the summer. They both make money, but they do it in offsetting ways so that at the end of the day, you get the same return, if not more, because of the rebalancing of cash flows, but with a lower volatility. So that is the Ray Dalio approach is their all-weather strategy that they offer institutions, and their pure alpha that they offer institutions, and then they let them mix and match what they want. We've been presumptuous enough to say 50-50 is probably good for advisors and investors. And then the final piece that we added that we're very proud of is the everything has a blind spot, and the blind spot for risk parity that's rarely talked about is liquidity shocks. So Mike talked about abundant liquidity. That benefits risk parity as well, because when there's abundant cash, everything floats, right? All boats float in a rising tide. But there are moments, acute moments like in October of 2008 and March 2020, where liquidity dries up everywhere, right? So in that crash of the COVID crash, you saw risk parity flatline while the market crashed in the first couple of weeks and then had a big drop. That was because they were flatlining because treasuries and gold was going up. And in the last few days, both equities, treasuries, and gold went down together. So that liquidity shock, the only thing that goes up in a liquidity event is volatility. And so we have an overlay that's almost always off, 95% of the time it's off. But when we identify through quantitative methods, when the term structure of the volatility markets change, we have the opportunity to go long the VIX and long the V stocks, which is the European VIX, in order to build that liquidity gap, right? So having identified that gap, we found a process to be able to fill that gap. And so those are, you're in essence getting 3 in 1. You're getting your best beta, your best alpha, and a tail protection overlay. That's what HRAA is, as an all-weather 100-year portfolio that also happens to fill a nice little gap for advisors as a sleeve on their traditional
very cool
portfolio.
That's very cool. Wow. I like the
we can see why we're excited about it.
I like the third turn there with the volatility overlay. That's very interesting.
Yeah.
I mean, that makes it even more interesting. Yeah.
Yeah. There's a bit of a story on that recently. Whilst Russia was invading Ukraine initially, and there was a lot of talk of all kinds of very serious implications for geopolitical issues. The red, if we think about that volatility tail protection strategy was flashing red. And so we had pretty significant exposure to the opportunity for significant bad, high risk outcomes where we had that hedge on. Now it abated, nothing happened. It didn't cost the portfolio too much. But it's certainly heartening when you get into those situations to see the portfolios responding and having protection from those types of extreme outcomes.
Absolutely.
And look, it added around, last I saw, 11 basis points to return for the year, so nothing much. But while it was on, it abated volatility.
Yeah.
right? So it's okay. Maybe we don't make a return there, but it minimizes the risk if you're caught offside. So that's been kind of neat to watch.
Yeah, I mean, you definitely sleep better at night. You touched on it already, but talk about how HRAA has no bias, and because of that, could be extremely painful to most investors to hold during a concentrated and prolonged bull market. I know we touched on it, but I think what goes hand in hand in that with that is that HRAA is expected to outperform during inflation and bear markets, but underperform during bull markets, right?
It depends on the bull market. So recall we've talked about the inflation and growth dynamics a lot today, and that they create those four regimes. And if you think about that chart that Rodrigo showed very early on, you could see when we're in a disinflationary growth period or even inflationary growth, a lot of stock bond portfolios can perform quite well. Where we get into stagflation or disinflationary growth, the 1929 period, 2008, and then stagflation would be the 70s. When you get into those periods, that traditional 60-40 portfolio does really poorly. And so now, remember, we talked about it's a comparative.
Right.
So if the particular zeitgeist of the moment for investors has a particular tracking error to it, whether that's NASDAQ or S&P or ARK, that is going to be an area where a well-diversified, properly balanced portfolio, even adding some alpha, it's going to underperform. You're just simply not going to compete with the best asset class. Now, most people aren't in the best asset class for the whole run. They're in it at the end. They're not in it at the start. So this is something where, and why we do so much education to keep them in these diversified portfolios when they're suffering this tracking error, this perceived underperformance. And then when we get an impulse like this and, oh, wow, look, crisis, necessity, change. Hey, change. You can think about changing some stuff, that they'll be comfortable enough and confident enough to actually make allocations and make changes to the portfolio. I think one thing that's really difficult is when you get losses in a portfolio, people won't make the change because they just want to hold back on until they break even, right? That loss aversion, behavioral bias. And so, if you're there early and you're kind of always prepared, you don't have to think about that stuff. It's happening underneath the surface. But if you're a little, offside or tilted, you're now looking at your portfolio. Maybe it's down 10, maybe it's down 20. You've got 90 cents on the dollar, and you're like, oh, maybe it's over. Maybe it's going to come back. Those commodities haven't done anything anyway. And so, having some discipline, getting some education, making sure you have, the understanding of what's going on to traverse the journey are important.
Yeah, Pierre, I don't want to tell you how much we're currently underperforming those that are obsessed with the natural gas market, for example.
Yes,
right?
Precisely.
Like that is a bad look.
Yeah.
Right. The point is, underperformance is relative to those people that really cared about NASDAQ, right? Or FANGs, or Tesla, or ARK, right? Like, it's even advisors that have been thoughtful about diversifying within equities, the ones that prefer S&P 500 over FANGs, have felt the pain of underperformance relative to what people cared about, right? So I think, broadly speaking, we could say that because we are diversified, and because most advisors are not, because you have the 60% in domestic equities, maybe a little bit of international, that when there is a very low inflation and really transparent market where everything seems to be working fine, when global communities are collaborating, where inventories are moving around freely, where there is no inflation, you're going to have a highly concentrated set of equities that are going to benefit from that clarity and growth. We're going to underperform that because we will have some of that, but we just won't have 100% of that. Now, switch over to when they perform poorly, inflation rears its ugly head. Growth stocks are a low duration asset. They require long time horizons. People that are willing to invest when inflation is low, they're willing to invest with a 30-year project that may or may not happen, more than when inflation is high and they're looking now at real tangible assets because they don't know what's going to happen with the gross assets. So all of a sudden you have these growth stocks go down. And so growth stocks are down aggressively. We look amazing compared to them. So we are likely to outperform in periods where that shift changes. And we're likely to perform really nicely because we have exposure to commodities and we have the ability to short bonds and so on, right? So in bear markets, we can short equities and we can go long the things that are working. Maybe at that point it's treasuries that we're long, right? So yes, I think one can safely say versus a domestically based 60-40 portfolio, we're likely to underperform in a traditional bear market, and we're likely to outperform in inflation periods and bear market periods.
Do you ever feel funny? Do you ever feel funny that I mean, you've been doing this for over a decade now, but do you ever feel funny that you have to constantly explain this? Does this feel like it's a constant? I mean,
honestly, no, not at all. No.
I mean,
I used to take
to
it
the
personally.
same person many times.
We're so fallible.
You remember we talk about this but they only talk to us once in a while, and they go back into the world and the real world, and they get hit by all this other stuff, and the financial, sort of the more traditional financial pornography out there is kind of steering them to just stocks all the time. And I think, adding to, a point on what Rodrigo was saying, what he's really talking about is dispersion, right? If there's only one market, or we have 10 markets to choose from, but they're all doing exactly the same thing, there's no opportunity to outperform. When 10 markets are fanning out and you have dispersion amongst your return vectors or your areas of return or your return rates of return, this gives the active managers the opportunity to provide differentiated performance. That's on stock indices as well as multi-asset. It expands in the multi-asset space because you have so many more unique bets.
Yeah.
As Rodrigo said, Apple and Microsoft, Google, these things are somewhat correlated.
Right? I remember
CIBC, Royal Bank, BMO, they're somewhat correlated.
Oh, come on. I remember the presentation that we did with Craig Lazara from S&P,
Right.
and the one point that I remember to this day was his point that dispersion was at a historical low, and that's
right. He did do that. I got to pull that presentation.
What was that? That was 4 years ago. Right? 3 years ago or 4 years ago.
And it continued until
last year,
6 months ago.
So
that's a point I'm trying to make. So I did my own dispersion analysis and saw that in the 2000s when we saw two bear markets and inflation go high, like you saw the commodity super cycle start in 99, end in February 2011. You were looking at peak dispersion, as in we measure it by bets, by just looking at, forgetting about the line items, just you can do a max diversification algorithm to identify how many unique things are pulling in different directions. And you would see peaks of like 25 unique bets. Fast forward to the last decade, we're looking at peaks of 5, right? So very different secular environments. And this kumbaya, peace and love, multinational, globalized economy has started to fall apart, and it's a lot harder to build something. It's a lot easier to break it. And so we've broken the system in many respects with the wars that we're seeing, with inflation that we're seeing. It's no longer US dollar against everything. It's cross currencies acting very differently, emerging markets that can do really well in a commodity bull market like Peru, South Africa, Argentina, which are exporters of grains and gold and silver and zinc. They're doing really well. And the emerging markets that import all of that are doing really poorly. So that's a type of dispersion that you can intuitively understand is happening and not likely to go away for a while. The same thing with sovereign bonds in different countries. Same thing with equity markets, right? All of a sudden, you go from FANGs being the winner, and hence the US being the only asset class that made any real money in the last decade, to opportunities absolutely everywhere. And the idea that this is going to end tomorrow seems to me outrageous. And so I think not just us, not in the multi-asset space, but I think we're going to go back to a point where Vanguard is like the wrong thing to do. This idea of passive equity investing at 5 basis points. We're going to go back to a time in the 2000s. If you recall, the best performing fund in the 2000s was Sprott Equity Fund that made positive returns in 2000, 2001, 2002 by being long only. Why? Because they went into the commodity space. Berkshire Hathaway made money by being a value manager, positive returns during those 3 years. So all of a sudden, we're going to go from the S&P market cap weighted index being the be all and end all at the lowest cost to advisors wanting to buy the best equity managers, buy the best active bond managers, buy the best multi-asset managers. And that's going to be a transition, but you're better for it, I think, given what we see in the
It's just, I just to go back to, Craig Lazara's point, which was, I felt like the underlying message there was just give in to passive, right? And I almost hated it.
Well, S&P launched the risk parity index shortly thereafter, right? Like the problem now is that I've always had this like, well, now Vanguard's going to suffer. Well, Vanguard just launched a bunch of active ETFs. Right? They're too smart. They're too smart for us. They're one step ahead. Everybody's just going to go from Vanguard passive to Vanguard active.
Well, there's also the issue. Active has, constraints. There are constraints of capacity and things like that have to be contemplated. So it's not quite that easy. And there's lots of herding and probably lots of behavioral alpha to be garnered as we go from here to there. And bit of fun along the way, hopefully.
So now it seems like a little bit of what you're doing is it's a bit of a black box approach. So imagine you have to do.
We think of it as a clear box, a glass box.
But you have to do a lot of work, obviously, right? You have to bridge that gap between the traditional, like if we've had 40 years of 60-40 and we've got 40 years of, we need so much confirmation bias, right? When we're making these decisions, I don't mean, specifically us, but I just mean in general, investors require so much confirmation bias. And, we've had 40 years of confirmation bias of how, to do a portfolio, how to have the stock bond mix. What would you say, just in order to help make that leap from the 60-40 of the last 40 years, bias, to abandoning some of the elements of that in favor of what you're doing?
Well, I think the one thing is, I'm not sure that anyone should abandon anything. Each individual investor needs to think about what their tracking error is, how they want to think about the comfort and discomfort that they're going to feel on the journey, both in tracking error to their friends and drawdowns, because these things will end the journey. And they always end the journey when someone has experienced maximum risk. And then what will happen inevitably is return will come, but you've crystallized your risk and you don't get the subsequent return. So you really have to be honest with yourself as the individual investor, looking at your circumstances, looking at your behavioral proclivities, and figure out what's real and true for you.
Yeah.
So once we get that out of the way, then you have to start thinking about how might I add these different types of strategies. And so we do get, sometimes, hey, there's a lot of math, you're doing a lot of calculus and whatnot, but there are humans there with significant amounts of experience and oversight that are constantly, watching the models, the portfolios that are coming out of the models. And there are things that your models don't know that you do know. And so there is practitioners. So we've been in this business. Our trader's been trading for 15 years. Our, head of Resolve Asset Management Inc., Jason Russell, has had 20 years of experience in futures. So the team is pretty steeped in experience in this marketplace. The rules or the systematic nature in which we build positions is simply because the dimensionality and the complexity of that space is not approachable by the human mind.
Yeah.
We have to do some calculus. We have to think about these things. And then we have to review that output and say, okay, where are the blind spots here and how might we manage those blind spots? Those blind spots are often fairly rare, and they beget the question, why is this a blind spot and why isn't that decision-making systematic?
So it's not actually a black box. I mean, I know
It's a clear
you
box.
weren't kidding when you said it's a clear box. It's a clear box. See, I think even if you just if you broke out your portfolio to everybody at any given moment on any given day, they wouldn't know what to make of it, right? Because there's so many components.
Well, this is where I think it's an
get
important,
a general idea.
I mean, they could, because we have done a strong effort. We've done a strong effort to be able to translate those many line items into something that makes sense.
It's clear to
right?
you.
So the efforts here requires education.
Yeah,
requires education, and it requires access, right? So we with Horizons have teamed up to put together a report at the end of each year, the attribution report, that shows top 5 long positions, top 5 short positions, top gainers, bottom gainers, and also the risk exposures, both long and short. So that people go right now, they'll see that last month we were net short bonds, we were net short or net long the US dollar, and so on and so forth. And they can get an idea of what's happening. We're also working on putting together a dashboard that provides live access to what's happening in the bond complex for the fund,
right?
What's happening in energy. So because it's different, there might be a day where we're down 2 and equity markets are up 1. They'll have questions. Clients will have questions. By being able to log in and check out what's going on underneath the hood, they are empowered to say, oh, I see that Resolve is long energies in a big way, and today the market's lost 5%. Those energy markets lost 5%. That's why we pay them. This is exactly as expected, right? So this is, again, trying to go from what may seem like I don't understand what's going on, to providing access and education through these means in your podcast and our personal podcast and the research report that we do. And once you do that a few times, you realize, oh, this is no different than anything else. I actually don't need to ask Coca-Cola, how they make Coca-Cola, and understanding that Coca-Cola isn't just that one beverage. It's a wide variety of distribution and different countries providing multiple products. And you want to go down that rabbit hole, or do you just want to kind of get an idea of what Coca-Cola is?
Well, like a bottle of Coke,
so on.
You can see what's in the bottle. So you guys are actually, I think what I want to clarify is that you guys are doing what you're doing. You're doing it in a fishbowl. Everybody can see what you're doing. If you want them, if they want to look at it, they can see it, right? So
if they want to look at it. Yeah, and they'll understand it. Yeah,
and but the illusion that there's some kind of a black box strategy happening there is just because of the knowledge gap.
It's much more. It's much more intuitive than people think.
It's sort of like, there are different types of people, and there are different types of wristwatches, and people would like to know the time. And some people just want a watch that says what time it is. Some people want a really fancy watch where you can see inside and you can see all the gears working. And, those people not only want to know what time it is, but they want to know how the time was calculated. And then there's other people who just ask a friend what time it is and don't wear a watch. So there's a lot of personalities out there about how you might want to tell the time. At the end of the day, if you're looking for non-correlated, I'm assuming you have one of these and you just look at the time there. But, I think it's just a function of what are you looking for? Well, if you're looking for a non-correlated, differentiated product that will provide returns when things might be shitty in the rest of your portfolio, i.e. non-correlated, and it's risk managed and has some of the features we've talked about today, well, then this watch is for you. And if you'd like to look at the inside of the watch, we will oblige you to look around the inside of the watch. It's fine. It's a clear box. We don't have a problem. There are some things that are proprietary, no question about that. We have to protect
absolutely
the internal knowledge and proprietary knowledge we have. We have to preserve that edge for the clients we have today. We can't give it all away for free, but we want to make sure you have a good understanding of how the watch works. Now, the next question is, are you the guy who's just going to ask your friend what time it is? Do you want the clear watch? You just want the watch? You're going to do it on your phone? We're happy to.
I just don't like the way it gets trapped under my shirt cuff. I hate that. All right. That's good. So what type of ongoing risk can people expect from HRAA?
Well, this is the great thing about having thought about this for as long as we have, right? You got to remember this was not built in order to create something that looks really good for marketing purposes. This was built because we wanted to put our own money and wealth in something that is as robust as it possibly can be, right? So what ongoing risks? Well, we target a level of volatility to make sure that we don't see any real outsized risks. The diversification from an intuitive perspective means that idea of the left fat tail in a distribution, that Nassim Taleb black swan event, once you diversify, and any advisor can do this by adding some gold, some commodities, some equities, some bonds with the right allocations, you'll see that the fat tails become really thin. So you're already managing that black swan risk. On top of that, you tack on the ability to go short and do it systematically. You start narrowing that distribution even further. So just broadly speaking, this has been designed for my employees, my families, my partners' wealth, and what I consider to be my extended partners, which are the advisors in the US, Canada, and globally that invest in our product. Now, everything that I just discussed is risk that we have diversified away that we understand and can see. Inflation, growth, liquidity. What is the non-diversifiable risk that from an academic perspective means we should expect a positive return above cash? Well, the non-diversifiable risk, they're largely due to the black box inside politicians and Fed governors' heads. And this is not a unique risk to us and HRAA. It's a unique risk, as we know, to every investor, whether you're an equity investor, a bond investor, or otherwise. When Bernanke came out and started raising rates unexpectedly in 2006 or even in 2008, right, when they thought inflation was out of control, that's a hit that wasn't expected. When Powell comes out and says, we are nowhere near neutral in terms of where rates should be, the market didn't expect that. That came overnight. Once the market realizes that the price of cash is here and overnight it's over here, the present value discounted mechanism means that everything goes down at the same time together, bonds, equities, commodities, the whole thing just takes a step down. And that is the risk that is non-diversifiable because it is very human and very immediate. So it just doesn't solve anything. Volatility will exist in a very diversified product like this. And that's the volatility that that pays for that excess return above cash.
It does.
Does that make sense?
It does. But that's why you have the volatility overlay as well, right? Yeah.
Yeah, but even then, that volatility overlay is more of a liquidity shock that happens over days within a drawdown. What I'm talking about is on a Sunday, the Fed governor thinks to do something and announces it on a Monday. And there is an immediate repricing of assets. That one you can't just diversify away from, you can't go long volatility fast enough.
Well, that's good. That clarifies things. So access is clearly important to most investors, and it seems like the ETF is ideal for most investors, but you guys you have offering memorandum-based hedge funds for accredited investors in Canada, the Evolution Fund and the Osprey Fund. For those accredited investors listening to this, can you tell us what you're trying to do with the hedge funds in contrast to HRAA?
Yeah, so the hedge funds, as I described what HRAA is, right? This is trying to democratize institutional quality, best equity, best long-only portfolio, the all-weather risk parity strategy, alongside a unique pure alpha strategy that has equal chance of going long and short with that tail protection, right? The reason that this works well in retail is, number one, at 8% volatility, most people will be able to stick to it long-term as a line item in their portfolios. And number two, it participates in global growth. 50% of the exposure is at all-weather, and yet a portfolio that will benefit from positive liquidity environments and will participate in that equity growth and that bond growth when it's appropriate. So we do provide a little bit of that traditional exposure while it being more balanced in a 60-40 portfolio. So this has been tried and tested in the United States. There's been plenty of products that have married good beta with good alpha over years. And it has, like Mike alluded to, stick-to-itness, right? Investors don't just require the pure mathematical best model. They require a combination or a proportion of the pure mathematical best model and their behavioral best model. And I think the best beta plus best alpha approach at a level of risk that people can take was ideal for the public product, HRAA. There's also constraints that exist within even a liquid alternative that don't exist in the hedge fund space. So there's a lot of money we're leaving on the table by just only offering a public product. So the offering memorandum fund allows us to target higher levels of risk. Right? So for the Evolution fund, targets a volatility similar to that of the S&P 500 at 15% volatility. So for those accredited investors and advisors that really do use that see it, are okay with having something that's very different, because the hedge fund excludes the beta part, excludes that risk parity. It's just offering the pure unadulterated alpha at a level of risk that matches that of equities. It means that if you're inclined to allocate to private product, the offering memorandum funds, you can now allocate less to a product like Evolution and get more bang for your buck, more diversification benefits. And because it has a zero correlation long-term to equities and a zero correlation long-term to bonds, it means that you can use it as a pick and shovel type of line item for your clients' portfolios, right? So that fund, in contrast to Horizons, is up around 33% year to date, right? So that's 3 times the exposure.
Wow.
So this is what the differentiation is. It allows being able to have no restrictions in terms of what the regulators have on public product. Actually creates opportunity and requires a bit of education and so on. But it is available in most platforms. It is in FundServe as well. So retail advisors can take advantage of this if they're inclined to do private OM product.
Amazing. That's actually pretty.
Did you add anything, Mike?
That you offer the different tiers of participation.
Yeah, I think it's great. We just need to OM seems to be, because of this massive growth in passive investing, it's become, people are willing to jump that hurdle less, but we're starting to see that change I bet these days.
Yeah, it's for, again, sophisticated, accredited investors, and there's requirements around that for those who can participate. And that's the regulatory regime we live in. And so those who are interested, certainly reach out and we can see if that's appropriate for you, or reach out to your advisor and ask them if it's appropriate. I think the one thing I would emphasize is just to put it out there, capital efficiency, that wording is what Rodrigo was talking about in that real estate in a portfolio. So, if you were having a 15% allocation to HRAA, you could probably get away with a 5% allocation to the Evolution product and have the same impact to your portfolio. That means, of course, you have an extra 10% of your portfolio that you could be invested in other beta assets. And so you'll have something meaningful in your portfolio that can really change the feel of a bear market from the portfolio, or change the feel of a inflationary impulse, et cetera. And we've written on that too. So if you want to learn about capital efficiency, it's, investresolve.com, and you can find it there. Just use that Googleplex.
Yeah, but talk about where investors can find you, where advisors can find you.
Yeah, I think if you were to Google either my name, Mike Philbrick, or Rodrigo Gordillo's name, there's going to be an absolute treasure trove of things. But certainly investresolve.com is the website. For social media, I'm on LinkedIn under my name, and then for Twitter, it's Mike Philbrick 99. And you've got Gestalt U is our partner and our CIO, Adam Butler, and Rod. I'll let you rhyme off your
Rod. Yeah, Rod Gordillo P. There was another Rod Gordillo without the P, so make sure you get that P in there for Twitter. And honestly, for the ETF, it's go to Horizons and look for HRAA. Look at under the corporate class, and you'll be able to see what all-weather equity lines look like. And then for the Evolution Fund, you can go to investresolve.com and go under strategies, and then alternative funds, and then Evolution Canada, because we offer these in different jurisdictions. So you'll be able to get in there and get all the information for that fund. So yeah, there's plenty of places to choose. We've written over 300 articles. We're over 120 podcasts on the resolved risks, and we wrote a book called Adaptive Asset Allocation: Dynamic Portfolios Designed to Thrive in Changing Environments. So plenty of places to look at. I think one of the ones that I want to emphasize is the Masterclass podcast series. You can just go to Spotify, look up Resolve's Masterclass.
And you can get
15 to 20 minutes
2.5 CE credits on Advisor Analyst too.
That's right.
You go to our CE page.
That's right. So you can go to you can go to the CE page and Advisor Analyst and get that CE credit if you're an advisor that needs them. And I think that's a great place to continue this journey. If you stayed with us this far, you want to reiterate and kind of solidify your understanding of what we talked about. That would be
and it's all there. It's all, I mean, it's all at Invest Resolve. It's all in your blogs. I mean, anybody who actually wants to learn, 300 articles. It's a pretty profound well of knowledge that you'll find there. Guys, we love you. We love what you do. Wow. Every success, guys. It's just, it's such an exciting time for you, and it's an exciting time for HRAA. Thank you so much for this incredible 90 minutes.
Thanks for having us. And
thank you.
We'll see you on Monday too. And the other thing is you raise your average. We're here hosting a myriad of other advisors and portfolio managers and just talking shop generally.
Thank you, Pierre. Really appreciate all your efforts and hope to continue to contribute. As anybody who hasn't been listening to the podcast, we like to poke holes in other people's thought process. So it's a fun thing if you have.
Absolutely. My average has been raised just by doing it. So thanks, guys.
Thanks, Pierre.